Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, hi, Jim. It's Friday, and it's good that we get together on Friday, and it has been an interesting week in the financial markets, and I think getting even more interesting.
And obviously, our listeners are paying attention to these interesting times. We have several questions to get to today. Our first question is about the bond market. What's your take on the bond market and where interest rates are going? Do you think they have to go much higher to curb inflation, or are long-term bonds oversold? Now, we've had a 40-year bond bull market and a similar bull market in stocks. Is this the norm historically?
It is the norm historically if you've read about all previous great financial bubbles, of which we're in. But to get to the bond market, yeah, it was a bull market for long bonds, price going up and yields going down. And that started when the U.S. long treasury was trading at 14% in 1981. And at that time, I was presenting our research to financial institutions using overhead slide projector. And I had one slide that said, no matter how much the Fed prints, stocks and bonds will outperform commodities. And with also the U.S. CPI inflation up to 14% then, that was highly controversial. So what we have been in is another new era, a new financial era, where all the action shifts over to the financial game. So where the bond market is going, well, at the moment, the long treasury is very oversold, and it could pop a short rally. The problem will be is the lower grade bonds, junk bonds, high yield, all that sort of stuff. There's been jillions of them issued, far more than the economy can service, and every post-bubble contraction, the yield for lower grade bonds has gone up, and in some cases there's so many of junk bonds default, and also investment grade bonds slide down to junk, and then they default. So post-bubble contraction in bond market is no man's land, and there could be times when the pressures in the junk bond market are such that it even pulls down prices of long treasuries. And so this is what we're looking at now. Brief pop in treasury markets, long treasuries or long Canadas, and then all down. I think there could be a liquidity crisis discovered after mid-year.
Question from Chris. Enjoy the show as always, guys. Here's the question for Bob. How high do you expect inflation to go? And what is the real influence of a foreign war in the Ukraine on inflationary pressures? How high do you think interest rates need to go to stop this inflation? And how high do you think the Fed will actually go? In relation to that, do spikes in inflation create or set off recessions? Thanks.
Yeah. Well, it's the problem out there is that the Fed and interventionist economists do not understand financial markets and financial history. So, and the best example is that in it was the big, huge commodity boom with the First World War that blew out in 1920. And with that, the U.S. rate of inflation annualized got up to 24%. I'm going to repeat, 24%. And whereas in 1980, which was the last real big high, was plus 14%. And then in 1929, the global crash in commodities was so severe that U.S. Rate of inflation annualized went to, I think it was minus 16%. So the Fed then was riveted by poor pricing power in the economy. So it was deliberately easy through the 1920s, which turned out to be the Roaring Twenties, and they were completely ignorant about great financial bubbles. And then what happens when a financial bubble's over? Everything deflates. So here we are now for most of the last decade, and there have been every week quotes by Fed spokesmen that inflation wasn't high enough. They had to keep it at 2% or something awful would happen. So they had the money taps open, and during a time when a great financial mania was possible. So we've ended up with a great financial mania, and the final phase of each of the great financial booms in the past have been accompanied by a business boom and rising commodity prices. So, but here this has been made doubly bad because authorities around the world, with the COVID lockdown, effectively shut down the economy. And at the same time, they opened up the taps on the credit side. And of course, the money went roaring into whatever the speculative items were, which is the gain stock and bond market, and more recently, commodity prices. So our work recently, for this year, is that the senior stock indexes might be able to hold themselves together into mid-year, supported by favorable base metal prices, copper, supported by the yield curve continuing to flatten, and also by credit spreads. So, but this week in the stock market's looking pretty iffy, and there's no question that the financial markets are precarious. So, yeah, it's time to build liquidity in your own portfolio right now.
Our third question quotes an article from The Walrus. I noticed this article from The Walrus saying that basically inflation is a good thing. They say nothing bad happened after the 2008 crisis and printing, so let's do it again. And of course, if you think back to 2008, how many thousands, maybe millions of Americans lost their homes? Something bad did happen. Yeah. Anyway, he's fed up with people playing with other people's money. My reaction is that inflation is a form of theft, since it steals money you've already earned by devaluing it. Even 3% inflation is theft. If inflation is 3% and I earn 3% in interest, I lose money, because the government still taxes that 3% gain as if it was real, whereas it's only a nominal gain. But they argue that inflation is going to potentially drive higher wage increases, and with the economy running a bit hot, potentially more employment for young Canadians, says the Scotiabank's Deputy Chief Economist Brett House. BWT or BTW, the president of the Alberta Labour Board, retweeted the article in approval, which is how I saw it. Some way to help the working man. What do you think of this claim, Bob, that high inflation will give us higher wages? In real terms, all the studies I've seen say wages haven't gone up since 1975.
Yeah, good question. And I did take the time to read the article. And the writer was trying to go with the flow and argue that inflation is good. But there are price indexes, good thorough price indexes. In England, there's one published called the 7 Centuries of Consumable Prices, and it begins about 1280 AD. Now, England's a good place to study prices because the country wasn't changing all of the time like borders do in Europe, and there are very good records. And I can tell you, there's records on, they've calculated what wages were and what inflation was, and wages never win. And people get screwed by inflation, and runaway inflation is always due to government policy. And it is, as you point out, and I agree, it is state theft. But it's been practiced as long as there's been some sort of coinage. The end of the Roman Empire was, the economy was destroyed by chronic inflation. And the data are interesting because while you cannot calculate a CPI index for Rome in the 3rd century, you also have the record of each devaluation. And eventually their standard coin, which had been mainly silver, ended up being copper with just a thin wash of silver on it. And inflation was the key destroyer of the Roman Empire. And then the 1500s was another period of chronic inflation, and it destroyed the economy in Europe and England, and then you got a reform to limit the ambition of government, and also society was able then to get off of inflation. So we've had another century plus of an experiment in authoritarian government, pushing taxes to the point of pain, and then supplementing it with currency depreciation. It's the same old evil, but it's coming to an end. I think that this bubble is beginning to fail, and when it fully fails, the people are going to look and see that the trillions of dollars that were spent of their tax dollars were spent to prevent a recession. And in the next recession, they're going to say, hey, your crazy system doesn't work. So I can see a major political reform that would include a reform of the central bank and get them back onto the discipline of a gold standard. And that then, it's hard to avoid central banking. And the only way it can be practiced is with the discipline of a gold standard.
Question from Bill. Greetings, Jim and Bob. Bob, I've noticed a lot of stocks and ELFs show a similar pattern for the ARK ETF. Basically flat or slowly growing over the past 5 years, then a suddenly massive 50 to 100% price increase, followed by a full return to the previous baseline over the past 18 to 24 months. What gives? Basically, during lockdowns, COVID uncertainty, protests, and supply issues, most stocks went vertical only to now slowly drift down to former levels or below. But meanwhile, the major indices like the S&P and NASDAQ have barely corrected. What's going on? What was COVID really about in relation to the markets? It appears to have done no harm. However, that's not been my experience with local businesses, friends, and family who have all had significant disruptions. Regards, Bill.
Yeah, Bill, thanks. That was a good one. You described that within this bubble, there are sectors or individual stocks that really soar, but then you said suddenly massive 50 to 100% price increases. They've been in the order of 10 times, and then they give it all up, and that is what we call the round trip. And it's been a mania. So you've got an index I saw over the last few years made up of the hot new issues that came out, and that's not a pretty chart. So the lockdowns were extraordinary, but it also showed that when a bubble was on and scheduled, it can dominate, and this is what you've had. So you've reached in a number of sectors absolutely unstable conditions, and they have been breaking down. You also have, beginning a year ago in March, when in Argentina and in Turkey, the announcements that their central banks had run out of reserves, like they ran out of their own liquidity, and you had a credit crisis in those countries. And then beginning in last June, the credit crisis was discovered in China. And then with the measures taken against Russia, you now have the contraction has hit Eastern Europe. And the only question has been is when does that global contraction hit the U.S.? as the senior market or the senior currency with the financial center in New York. And it is inevitable once these things start. So our projection from the first hit in the markets this year is you might be able to get some recovery into mid-year. We use the old line about sell in May and go away, and I begin to think this is valid right now. So the idea that the senior indexes like the S&P and the Dow, well, the whole world has been buying those stocks, and it's going to be hard for them to change. They'll have to see major cracks before that bullish attitude goes away. And as I say, major cracks are appearing this week. And then you have seasonally, things can be good from October to May in most things you look at, whether it's base metals or stocks, that sort of thing. And then after that, they can be seasonally bad into around October. It's the annual thing. And what makes it particularly interesting is that when you're in a year when a major financial bubble is completing, then the period of the season of contraction can be extremely interesting. So, yeah. So COVID was an outlier, but the financial bubble continued, and the financial bubble has reached extremes that could be soon followed by the typical contraction. Thanks for the question.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some headlines that caught your eye. The first one, MSNBC. It's our job to control how people think, not Elon Musk's.
Oh, yeah, that's the authoritarian side out in full force. And, of course, it had to do with Twitter. And Twitter is supposed to be a public forum for the exchange of ideas and information. But the people who run it are all gone crazy authoritarian and use it for political ends, which is evil. And Musk has made a move to, well, he bought 9% of the stock and is now making a move to take it over. And he has said that should he take it over, Twitter would go back to being a public forum, not an agency of propaganda. And it's a very good idea. But, of course, the left is furious about this. It needs its monopoly on ideas to survive. So it'll be fascinating to see how it goes.
Next headline, if the Fed is fighting inflation, why is the balance sheet still expanding?
Yep, that's an interesting one. And it reminded me of 1980 when that huge global boom in commodities blew out. And, of course, interest rates went up with it. And you can point out for 2,000 years that when you're in a period of business boom and prices are rising, interest rates go up. This predates central banking by a few thousand years. So the idea that the Fed can raise rates to end inflation is totally absurd, because in 1980, Volcker ended up being called a genius because he personally ended that bout of inflation by raising interest rates. But if you look at the data at the time, the T-bill market moves first in rising, and the Fed is followed by about 4 or 5 months. So it's just merely along for the ride. And then when the contraction starts, interest rates go down. So and also in that 1980 transition from inflation and tangible assets, which of course was commodities and things, and it changed to inflation and financial assets, which has been the predominant game since. there was no change in the growth rate of M2, which was what everybody focused on 40 years ago. So nowadays they focus on the Fed balance sheet, and I think it as it was in 1980, the Fed was talking the talk, not walking the walk, and market forces brought down commodities in an enormous crash, and then that released the party in the financial markets. So now we've had another go at it. The last high for commodities was a good boom in 2008 when crude oil went to 147, and then the other boom in 2011. And the pattern has been that once you've had a global boom in commodities, you go into a period of inflation in financial assets, and that can conclude about a decade later, and which is what we think is going on now, because you've had technical excesses clocked in this thing that are absolutely enormous. So the Fed is talking the talk but not walking the walk.
Another headline, the junkiest of junk bonds flash a warning on the economy.
Yeah, I like that one, Jim. The junkiest of junk. A good headline writer on that one. And the low-grade bond market has been hit very hard, and that is a change from when everybody was in the yield side of the spectrum was reaching for yield because they were confident that nothing could go wrong. And then since last summer, junk bonds have been in the tank, maybe getting a little oversold recently, but it is a sign that the economy is beginning to falter. So, rising long rates for low-grade stuff at the same time as you get the T-bill rate going down will be the signal. At the moment, the 6-month T-bill rate is still increasing, but we watch it for the change, because in 1929, the T-bill rate declined into that May, and when it's turned over and started to decline through the summer, it was signaling that the boom was over. So there's always fascination out there, Jim.
Headline, Russia ruled in potential default over ruble payment on debt.
Yep, they're going to have, with some revenues being diminished through some reduction in their crude oil and natural gas sales, they're going to be a little pressed for money, and then also the expenditures on their very foolish war in Ukraine is costing them huge. So they whatever operation they did to get the ruble back to where it was before the war started was very good, because historically it's been very difficult for a country to service its debt from its weak currency into the firm, stronger senior currency. And of course, this is what's happening now. You've got the U.S. dollar trading up to new highs. And this is at a time when too many pundits are tearing their hair about inflation. Yeah, the inflation number is up to something like 7%. It need not be there. But the dollar going up is symptomatic of a post-bubble contraction. So, oh boy, Jim, it is so interesting out there.
Also, I saw a headline, the London Stock Exchange is considering to refuse to recognize the existence of the Russian Stock Exchange, and this follows Putin signing a decree removing Russian stocks from foreign exchanges.
Oh yeah, that's like schoolboy pushing and shoving in the schoolyard, you know, and they're each trying to hit each other, and but overall, the financial markets are very precarious, and this war is doing immense harm.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be with you, and as I say, the markets are fascinating, but they're also very precarious.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob and he loves to answer them, you can send them to info@housestreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.